Hi everyone, this is Paul Stewart here from Elite Wealth Services and Segmented Solutions Limited. Just doing another one of my technical training videos for you to walk you through some of the tax issues related to offshore residents who are buying UK property. Like all videos, this is not deemed to be any form of tax or professional advice. It's just to give you some information about the key pointers and things to bear in mind, and also some ideas on how to structure your affairs. So without further ado, offshore residents buying UK property. As the name suggests, you're offshore and you're not paying tax to the UK, and actually if you buy property in the UK, it might be that you have to register for UK tax, which can be a bit of a pain. And so we want to use some tax exemptions that are out there in order to allow you to have a portfolio of property in the UK such that you can get rent or profit. You can actually do property developments as well as long-term investments, and all of that will be free from UK taxes. So without further ado, let's have a little walkthrough of the scenarios, the taxes, and of course the solutions. Okay, as a bit of background, I just wanted to run you through some details about ourselves. We have Elite Wealth Services Taxation Limited here in the UK, provides specialist advice to company directors, business owners and wealthy entrepreneurs, and I've been in this space for about the last 35 years. I also own and run Segmented Solutions Limited. Now, we are a SaaS provider. We assist businesses with the establishment and ongoing running of self-administered pension schemes, and we've also got a complete portfolio of training videos, so you don't need to pay for courses on SaaSes. All of the information there is freely available, and for my sins, I used to be an examiner in the pensions arena, so the financial advisors who are qualified to give advice on things like pension transfers were trained by me many moons ago. I'm also involved in technology and digital marketing, and one of the things that I have done is produce a chatbot which is SaaS related. So if you're interested in using pension money inside a SaaS and you're interested in investing in commercial or residential or mixed use property or land, that chatbot is actually really useful because it allows you to put in your scenario and it will write you a comprehensive report covering all the issues with regards to the pensions, the tax, VAT, stamp duty, connected parties, transaction, all of those sorts of things. So I deal with software as well as the technicalities. But, and this is a really important big thing, there's nobody on this planet who knows everything about everything, and I'm just scratching the surface after 35 years. So we do a lot of work with other companies that are specialists. So for example, Cornerstone are experts in stamp duty, land tax here in the UK, and we will defer to their knowledge and we can refer cases to them where it's needed. In conjunction with the two companies and the external support, we also get involved with using a variety of structures, because the key is to build a solution that fits your situation. So we get involved with QNUPSs, which are qualifying non-UK pension schemes, GDCVs, which we'll come on to later in this session, obviously SaaSes, because we run a SaaS business, also deal with employee ownership trusts, where people can sell their UK trading business for multiple millions of pounds and pay no tax whatsoever. So it's a good combination of experience, connections and tools, rather than me sitting here saying you definitely have to have a SaaS or you definitely should do this. Everything is driven by you at the starting point in terms of where you are, who you are and what you're trying to achieve. So with that in mind, we go back to the basic principles. It's the source of the funds. So if you're a wealthy individual offshore and you're wanting to invest in UK property, a lot of the times you'll be pointed at putting your cash into a UK limited company, which may be absolutely the wrong thing to do because it will expose you to all sorts of taxes. It might be that you've got a business, a trading business, either in the UK or offshore, and that business is generating profits and you want to be able to use that to invest in UK property. Or it might be that you're now offshore, but you've built up pensions in your own right in the UK, either through company pensions, SIPs or SASs, etc. So the source of the funds really starts the conversation going, because it's how do you get that money into UK property in such a way as to protect yourself from the exposure to UK tax. That's really what this is all about. Okay, so let's have a look at some of the taxes imposed for offshore investors. It's important to realise that in the UK, HMRC, who deal with the UK tax, are perfectly allowed to change the legislation to withhold money from you and apply taxes to that money before releasing it to you, even if you live in an environment offshore which pays no tax. So here's a quick example, looking at residential lettings. If you are a non-resident landlord, then there'll be 20% withheld on your gross rent that comes in, and that withholding amount of tax will be paid to HMRC on your behalf, either by your agent or indeed by your tenant, unless of course you have registered with HMRC and you do a tax return. So you could be living anywhere on the planet, but sadly if you own residential property in the UK, you're going to have to register for tax. Another way of doing things is to potentially lend money into a corporate structure in the UK and hope that you can charge interest, because that's a business expense for the structure holding your property in the UK, and you don't pay tax on any interest. Sadly, HMRC have cottoned onto that one as well, and they'll start charge a withholding tax. So there'll be 20% withheld on the loan interest. Obviously, there's capital gains tax when property is sold, and this depends upon how the property is held. Basically, worst case scenario, 28%. So I would err on the side of that being the rate that applies. So yeah, you can be in a completely tax exempt part of the world, but still UK tax applies to your property portfolio. There's also a thing called annual tax on enveloped dwellings, which is a complicated thing, but ATED is an additional annual tax, and you can actually be fined for not declaring it and making the relevant reporting to the revenue, even if the tax rate is naught. So this is one that catches a lot of people out. All of these taxes are applied irrespective of the fact that you don't have a footprint in the UK at all. And this is one of the anomalies. Property is indeed one of the areas where a 0% taxpayer abroad will need to pay UK tax. And what we're trying to do here is provide the education and support to be able to look at different structures to work our way through this minefield to avoid the tax. So let's look at a couple of tax-exempt structures. Structure number one is a small self-administered pension scheme, and it is set up by a company, and that company allows the pension scheme to have multiple members, so you can pool multiple pension schemes in. So if you've got a husband and wife and a grown-up child, they can all pool their pensions into the one pot. And the SAS is a trust, and it's a single trust which contains multiple members. It is a UK pension and therefore is a UK landlord, and therefore it sidesteps a lot of the tax issues for offshore landlords. So it's very useful in that sense. And being a pension, it's exempt from tax. However, you have to be careful. It's not allowed to trade. So a pension like a SAS can buy a property and put a tenant in on a long-term lease, and that'll be perfectly fine. There'll be no tax to pay on the rent. However, if you buy a property such as a commercial property and your intention is to convert that to flats for residential, for example, you'll fall foul of the fact that that's actually a trade. So you have to be very, very careful and not trade. The other thing is you're not allowed residential property, and in that example I mentioned about converting a commercial property into residential, the minute the property becomes deemed to be residential, there's punitive tax charges applied to the pension scheme. So trading and residential property are the two weaknesses within a SAS, which are perfectly able to be worked around, but bare naked, just on its own, a SAS has the pluses and minuses. There is another structure called a qualifying non-UK pension scheme, and this is set up by individuals, and the individuals put their personal money into it. There's no tax relief on money going in. It's not money which is coming from a pension transfer from anywhere else. This is not a QROPS, this is a QNUPS. And as an individual investing in a QNUPS, you are allowed to have residential property, which is great. That opens up greater opportunities to you. But again, because it's a pension scheme and it's based offshore, you're caught by the offshore landlord taxes. And if you try and work around them, you'll fall foul of the loan arrangements. And again, like any pension scheme, they're not allowed to trade. So pensions are wonderful because in UK terms, they're tick in the box, everything's tax exempt, except if you trade. And these weaknesses can actually be worked through to come up with a solution, which we'll come on to in a moment. But the key here is to make proper use of the tax exempt structures, because they are the most robust in terms of planning your property portfolio. How to solve all of the negatives. So just to make sure you understand this, a SAS is brilliant. It's a pension scheme in the UK, and everything that happens inside a SAS is exempt from tax. However, there are limitations. It can't get involved with residential property. It can't get involved with trading, and so there are a couple of downfalls. With a QNUPS, it's offshore, so it immediately suffers from all of the offshore landlord issues. So how do we solve those? Relatively simply, there is a description at HMRC's end of a thing called a genuinely diverse commercial vehicle. Now, GDCV is not a particular thing. It is a badge that you wear to say, I passed the test. So a GDCV could be a company, it could be an individual, it could be a trust, it could be a whole range of different things, but it's a very important term. And if we look at it from the SAS's perspective, a SAS can use its money to buy into whatever this GDCV thing is, and same thing with a QNUPS. It can use its money to buy into this GDCV, and from that point on, the legislation inside the GDCV says that it's allowed to do things, and most importantly, a GDCV of a particular type is allowed to trade. So you can buy property with the absolute intention of doing it up, selling it, converting it, all the things that you conceive as a property business can be done inside a GDCV. The other thing is residential property is allowed, so you don't need to worry about your pension scheme switching from commercial to residential. You don't have to pay the huge costs of strange finance to finance your way out of the problem. It's a lot simpler just to say, I've invested my money into a GDCV and away I go. And of course, the GDCV that we're talking about is a UK-based situation, and I'll go into it in more detail, but it's a UK landlord, so there's none of the offshore landlord restrictions that apply to it. So the GDCV can trade, it's allowed residential property, it's a UK landlord, it's allowed to borrow money, and it's not restricted in the same way as pension schemes are in terms of borrowing. But it also is a structure that's allowed to use some of the enveloped dwelling exemptions. So it's really, really important that you understand that GDCV is the key that opens up your tax exempt property planning, whether you're UK based or whether you're offshore. Now, you're probably asking by this stage, what on earth is a GDCV? And I've got a whole video on this and how it applies to SASs and all of that. But for now, let's just quickly go back and have a look at what is a GDCV. It's a piece of terminology, not a thing. So a genuinely diverse commercial vehicle are effectively a set of rules, and if you are able to pass all of those rules, you, as a company, as a structure, as an individual, you are allowed to be called a GDCV. And these are defined by HMRC in Schedule 29A of the Finance Act that governs the pensions rules. In our case, we're talking about a UK-based unit trust. So our GDCV that we're talking about for SASs and for QNUPs is structured as a unit trust. So what happens is your SAS or your QNUPs buys units in a unit trust, a straightforward bona fide investment. From that point on, all of the property activity happens at the GDCV level and doesn't need to be reported to HMRC in the same way. So it's outside of the scope of your SAS and outside of the scope of your QNUPs in terms of reporting. It's very similar to having a pension fund and buying yourself a legal and general property unit trust. HMRC don't go to legal and general and say, do you have any residential property, or are you doing stuff up and then selling them? They are two completely separate camps. So it's a very good way of effectively sidestepping a whole raft of the rules and regulations that normally apply to property investments inside things like QNUPs and SASs. And a unit trust is structured in such a way that it doesn't have to pay UK corporation tax, because once it gets approved and accepted by HMRC and gets its registration number, all of the tax actually applies to the holder of the units. And if your SAS or QNUPs is the thing holding the units, both of those are pensions, and therefore both of those pay no tax. So you can have your property developments, you can have your property purchase, and you can have your rent, all of those things happening inside a GDCV, and there's no tax to pay because it's held by a SAS or a QNUPs, and both of which are pension schemes. So that's a very quick run through of two structures, the SAS and the QNUPs, both of them being supercharged by the use of a GDCV. And the one that we use, they're not property investment experts, so they defer the investment decisions to yourself, and that means that you are actually in control of your funds, and you can get on with your property decision making based on the validity of the property you're looking at, rather than having to mind your P's and Q's with regards to residential, commercial, onshore, offshore, etc., etc. Okay, so let's go right back to the beginning. Don't forget, the advice in terms of what's the best thing to do will be driven by the source of funds and what it is you're trying to do, rather than you joining a queue to say, I'll buy one of those structures. So it's very, very important. Not everyone needs a SAS, and in the UK you would think that the SAS is needed for everybody in every situation, but sadly it's not quite the case. So we look at individual wealth, we look at company profits, and we look at pension arrangements. And it might be that you actually need both a SAS and a QNUPs working together with your GDCV. The other thing is you might have an existing UK company holding property which has got all of these tax issues, and it is possible to unwind things using a GDCV in terms of in specie movement of property in exchange for units. But anyway, I don't want to get too technical, because at the end of the day everything is driven by your scenario, and that's where we come in terms of our client pathway. It's very simple, very straightforward. We do a lot of professional briefings and training courses, and as you can see, videos as well for accountants, advisors and other people around the world. But from there, clients are offered a free consultation. This is where we talk on the phone, where it gives us a chance to get a glimpse into what your situation is and what you're trying to achieve, because only once we've done that can we identify planning opportunities. And again, it might be that a planning opportunity exists which is too costly for the funds available for it to be worth your while. So we don't just look at what is possible, we also look at it from a commercial perspective in terms of what is economically acceptable. There's no point spending an awful lot of money on a structure to reduce tax if what you're spending is more than the tax in the first place. Only once we've identified opportunities and we've spotted that there's something that is affordable and acceptable financially do we actually engage clients, and then we move things forward to implementation. So that's a little bit about us and myself. I'm Paul Stewart. My email address is paul@elitewealthservices. My mobile number is there. On the website segmentedsolutions.co.uk you'll find a complete masterclass in everything to do with SASs. You'll also find a video explaining how to set one up step by step. All the paperwork explained and all the forms and bits and pieces are actually fully downloadable. I do have a smart business card, and the QR code you can see on screen at the moment links you directly to my smart business card. Inside there are all of the videos, all of the forms for establishing a SAS, and of course there's Elite Wealth Services. So again, it's been a pleasure to give some of my time back to let you learn a little bit about how things can be structured properly, but don't be drawn into people trying to sell you an individual product. It doesn't work like that when it comes to tax advice. Anyway, hope you are successful in whatever property investments that you're planning on doing, and thank you for your patience.